Gold is once again at the center of global market attention. After a volatile trading week, investors and traders around the world are asking the same question. Will gold open higher with a bullish gap when markets reopen, or will it continue its recent decline and gap lower? The answer could have major implications not only for gold traders, but also for investors across stocks, bonds, currencies, and commodities. Gold has long been considered one of the world's most important safe haven assets. Whenever uncertainty rises, investors often turn to gold for protection. But when confidence returns and risk appetite improves, gold can quickly lose momentum. That is why the upcoming market opening is attracting so much attention. Several powerful forces are currently shaping the direction of gold prices. These include U.S. monetary policy, the strength of the U.S. dollar, inflation expectations, global economic uncertainty, and perhaps most importantly, geopolitical tensions in the Middle East. Together, these factors are creating a highly uncertain environment for investors. In today's video, we will break down everything you need to know. We will examine what happened to gold last week, why investors remain cautious, what could trigger a gap up or gap down, and what the most likely scenarios are for the days ahead. Let's begin. Gold entered the previous week under pressure. After reaching historically elevated levels earlier this year, the precious metal struggled to maintain upward momentum. Profit-taking activity increased. Some investors decided to lock in gains. Others shifted funds toward assets offering higher yields. As a result, gold experienced a pullback. By Friday's close, prices had retreated from recent highs. Although the decline was not catastrophic, it was enough to raise concerns among bullish investors. Many market participants began questioning whether the gold rally was losing strength. At the same time, the U.S. dollar remained relatively strong. This is important because gold and the dollar often move in opposite directions. When the dollar rises, gold tends to face downward pressure. A stronger dollar makes gold more expensive for buyers using other currencies. This often reduces demand and limits price gains. Throughout the week, traders closely monitored developments related to the Federal Reserve. The Fed remains one of the most influential institutions in global financial markets. Its decisions affect borrowing costs, investment flows, and economic expectations worldwide. Recent signals from policymakers suggest that interest rates may remain elevated for longer than some investors previously expected. This matters because gold does not generate income. Unlike bonds or savings accounts, gold pays no interest. When interest rates rise, income-producing assets become more attractive. As a result, some investors reduce their exposure to gold. This relationship has played a major role in recent market movements. However, monetary policy is only one side of the story. Geopolitical risk remains another critical factor. Over the past several years, global investors have repeatedly witnessed how political instability can drive sudden movements in financial markets. Whenever tensions escalate, demand for safe haven assets often increases. Gold is usually one of the first assets to benefit. That is why developments in the Middle East continue to attract significant attention. Although there have been efforts to reduce tensions and promote stability, uncertainty remains. Markets are highly sensitive to any signs of escalation. Even a single unexpected event can rapidly change investor sentiment. If tensions increase over the weekend, traders may rush into gold as soon as markets reopen. This could result in a bullish gap higher. On the other hand, if diplomatic progress continues and risks appear to diminish, safe haven demand could weaken. In that scenario, gold may struggle to attract buyers. Understanding this balance between risk and optimism is essential. Markets are constantly evaluating probabilities. Investors are trying to determine which scenario is more likely. Will uncertainty dominate, or will confidence return? At the moment, opinions remain divided. Some analysts believe gold remains fundamentally strong. They argue that global debt levels continue to rise, government spending remains elevated, and long-term concerns about inflation have not disappeared. From this perspective, gold still serves as an important hedge against uncertainty. Supporters of this view believe that any short-term weakness may ultimately create buying opportunities. Others are more cautious. They point to the strength of the U.S. economy. They highlight the resilience of the labor market, and they emphasize the possibility that interest rates could remain restrictive for an extended period. According to this argument, gold may face additional pressure before finding its next major support level. This disagreement explains why the upcoming market opening is so important. It could provide valuable clues about investor sentiment. A strong opening would suggest that buyers remain confident. A weak opening would indicate that sellers still control the market. Let's take a closer look at the possible scenarios. The first scenario is a bullish gap up. This outcome would likely require a catalyst. One potential catalyst could be a significant geopolitical development. If investors suddenly become more concerned about global stability, demand for gold could rise sharply. Another catalyst could be signs that the Federal Reserve may eventually adopt a more accommodative stance. If markets begin pricing in future interest rate cuts, gold could receive additional support. In a bullish scenario, traders may view recent weakness as temporary. They could interpret the pullback as a healthy correction within a broader uptrend. As buying activity increases, prices could quickly recover. Momentum traders might then join the move. This would further strengthen bullish sentiment. The second scenario is a bearish gap down. This scenario would likely occur if investors become more confident about economic conditions. A stronger dollar could also contribute to downward pressure. If market participants believe interest rates will remain higher for longer, gold may continue to struggle. In this environment, some traders may choose to reduce risk exposure. Others may rotate capital into assets offering higher returns. The result could be a lower opening price and continued weakness during the early trading sessions. A bearish gap would not necessarily mean the long-term bull market is over. However, it could signal that further consolidation is needed before the next major advance. The third scenario is perhaps the most realistic, a relatively flat opening. In this case, markets would continue digesting recent developments without making a decisive move. Investors would wait for additional information. Economic data releases could become the next major catalyst. Statements from policymakers could influence expectations, and geopolitical headlines could continue shaping sentiment. Under this scenario, gold might trade within a defined range while market participants search for direction. So which outcome appears most likely? At the moment, many analysts believe the probability of a dramatic move remains limited unless new information emerges during the weekend. The market has already priced in much of the known information. Therefore, unexpected developments are likely to have the greatest impact. This means traders should pay close attention to news headlines before the market opens. Events occurring while financial markets are closed can create significant price gaps. This is especially true in the gold market. Unlike stocks that may be influenced by company-specific news, gold responds to a wide range of global events. Political developments, economic reports, central bank decisions, currency movements, and investor psychology all play important roles. Another factor worth considering is inflation. Inflation remains one of the most closely watched economic indicators. If inflation expectations begin rising again, gold could benefit. Historically, many investors have viewed gold as a store of value during periods of declining purchasing power. However, the relationship between inflation and gold is not always straightforward. The Federal Reserve's response to inflation often matters just as much as inflation itself. If inflation rises, but interest rates rise even faster, gold may still face pressure. That is why investors monitor both variables simultaneously. Looking beyond the United States, global economic conditions also deserve attention. Several major economies continue facing challenges. Growth rates vary significantly across regions. Some countries are experiencing stronger recoveries. Others continue dealing with structural issues. This uneven economic landscape contributes to uncertainty, and uncertainty often supports demand for safe haven assets. Meanwhile, central banks around the world continue playing an important role in the gold market. In recent years, many central banks have increased their gold reserves. These purchases have provided additional support for prices. Gold remains a strategic asset for many governments. It offers diversification. It provides a degree of protection against currency volatility, and it serves as a symbol of financial stability. As long as central bank demand remains strong, gold may continue benefiting from an important source of long-term support. Investor sentiment will also be crucial. Financial markets are influenced not only by economic fundamentals, but also by psychology. Fear and greed often drive short-term price movements. When investors become optimistic, risk assets typically perform well. When fear increases, safe haven demand tends to rise. Gold frequently reflects these emotional shifts. That is why sentiment indicators can sometimes provide valuable insights. As we approach the new trading week, the battle between bullish and bearish forces remains unresolved. The bullish case focuses on uncertainty, geopolitical risk, central bank demand, and long-term inflation concerns. The bearish case emphasizes higher interest rates, dollar strength, and improving confidence in economic conditions. Both sides have valid arguments, and both sides are watching the same market opening. For traders, risk management remains essential. No one can predict market movements with complete certainty. Unexpected events can change the outlook in a matter of minutes. Successful traders understand the importance of preparation. They define their risk, they remain disciplined, and they avoid making emotional decisions. Investors should remember that short-term volatility does not necessarily determine long-term trends. Gold has experienced many corrections throughout its history, yet it has often maintained its role as a strategic asset within diversified portfolios. The key is understanding the forces driving market behavior, and right now, those forces are unusually powerful. The coming days could provide important signals about the next phase of the gold market. Will buyers regain control? Will sellers extend their advantage? Or will the market remain trapped between competing narratives? The answer may begin to emerge as soon as trading resumes. One thing is certain: the world will be watching. Because gold is more than just a precious metal. It is a reflection of investor confidence, a measure of uncertainty, and a window into the broader global economy. The next opening bell could reveal a great deal about where markets believe the world is heading. And for investors, traders, and policymakers alike, that makes this one of the most important moments to watch. Thank you for watching Economic Horizon. What do you think will happen to gold this week? Will XAUUSD gap up, gap down, or remain relatively flat? Share your thoughts in the comments below. Don't forget to like this video, subscribe to the channel, and share it with others interested in global markets and economic trends. Thank you for watching Economic Horizon. See you in the next video.